Hi, everybody. Thanks for joining us for this class on fun and useful spreadsheet analysis. This is Charles Roberts, and I have with me today Joe Massey. Joe, say hi.
Hi, it's Joe Massey from Castle & Cook Mortgage.
So let's do this again. This is Charles's voice and
Joe Massey.
So we are going to be talking to you about why you want to understand spreadsheets. And before you say, oh God, I don't want to understand spreadsheets, what I'm going to do is I'm going to tell you that you do want to understand a little bit about spreadsheets. And the great news is that Joe put together the world's simplest and most powerful spreadsheet. And we're going to go through a couple of examples where after just a few minutes, you're going to have the power to really understand and analyze a property in a way that you may not be able to do. So hang with us for a couple of minutes. I'm going to show you a couple of examples of properties that my clients have purchased that Joe has done the loan on. And I'm going to show you this simple and easy way to begin analyzing properties. So why do you need to understand spreadsheets? Now, let me tell you the truth. I've been doing this for 20 years. I started investing 20 years ago, and I didn't know what a spreadsheet was then, and I didn't know what it was 18 years ago and 16 years ago and 10 years ago. You can buy properties and do very well in real estate without understanding spreadsheets. I'm an example of someone who jumped in, didn't know what they were doing, made some mistakes, but hey, I got through it. But why would you do that? After 10 or 15, 20 minutes, I'm going to show you a spreadsheet that is so simple and so powerful that I'm hoping you're going to say, oh, I got it now. Right. I can just enter a couple of numbers and begin to get an understanding of a spreadsheet. That's really the goal here. It is going to make your life better and I think make you a better investor. That's my opinion. Joe, why do your clients use a spreadsheet?
Well, I think it's really important if you're investing in any sort of financial product, you're buying stocks, you're buying bonds, you're buying real estate, you're buying gold, whatever it might be, I think you need to have some sort of tool to measure how much money am I putting in, how much money am I getting out, is this a good investment, am I happy with this investment, do I want to put more money in, do I want to put less money in, and so a lot of times we'll meet with investors and they say, oh, this is a great deal, and then we look at it and we're like, no, it's not really a great deal. Or we'll meet with investors and they say, well, I'm only looking for great deals. And we say, well, okay, what exactly would you describe as a great deal? And they can't really tell us. And so having clear understanding and clear metrics will make it easier for you to understand what is a good deal, what's not a good deal. What is a good deal for me might not be a good deal for Charles. What is a good deal for me might not be a good deal for you. So this is going to give you some comparison points. It's going to help you clients work with your agents to show the agent this is what I'm looking for. It's going to help your agent be able to find those good deals, good transactions that meet what you're looking for.
So the way we're going to ground this, I'm going to show you examples of a couple of properties that clients of mine bought that Joe did the loans on, and we're going to show you the analysis we did, and truly it's just going to be a couple of minutes. So this property here was a property on 9675 East Kansas Street. This is the MLS listing. It was right out of the MLS. It's a 3-bedroom, 2-bath. This was 1,240 square feet. This was a property that my guy bought to build long-term wealth. And now what I'm going to do, hang with me for 1 second, is I'm going to open up the spreadsheet on 9675 East Kansas Circle. And here, this is the actual spreadsheet. I want to make sure that this is going to look good for you. Okay? So what we're going to do now is walk through the spreadsheet. Joe's going to take the lead on this. This is him right here. This is the guy who actually programmed this spreadsheet. These are the actual numbers of what we paid, the interest rates, etc. And the result is going to be you're going to have some great insight on this property as Joe walks through this with you.
Okay. So the first thing to understand about this is the spreadsheet. You can download it on the website. The link is on the page here. You can see it down below this video. So just click on that. You can get a copy of this so that you can input this information and use it for yourself, your own properties. The instructions are right here. It's really simple. Just go right down the sheet. You put out information on each of these highlighted fields. Make sure you include the correct number of units. Be sure that everything down at the bottom has appropriate comments that I'll show you. And then after that, you just go over to your next tabs and you can see the cash flows of the properties, the long-term analysis, etc. So we're going to start, and the important thing to understand is the majority of the spreadsheet is locked. You can't click and make changes over here. You can only change what's in the yellow. All right, we did that so it's pretty easy for you so you don't have errors. So you're going to start with the property address. So this was Kansas Street. And the number of units, this works for 1 to 4 unit properties. So if it's a fourplex, you can put down a fourplex. And the spreadsheet will give you some warnings. Hey, borrower needs to put down more money. 20% down doesn't work with a 4 unit. All right, but for a 1 unit, it does. You can do 20% down. So, Charles, this client put 20% down on this property. Is that right?
He did, yep.
Okay, and the purchase price was $181,000, which we saw back on the MLS sheet. The cost to buy this property, acquisition cost. When you highlight over here, this is all the closing costs associated with buying a property outside of the loan. This is things like your homeowner's insurance, inspection, the appraisal, transfer taxes, title insurance, recording fees, closing fees, other expenses or things like HOA transfer fees. If you have personal property tax or real estate property tax that needs to be included on there. All right, that's where you're going to put this in. It was roughly $2,500. Loan costs are going to calculate automatically. This factors in 1% buy down depending on your interest rate, depending on your down payment, and also factors in your underwriting and processing costs. As you put down more or less money, you may not have to pay as many points. All right, so that'll automatically update for you. All right, but in this scenario, they put 20% down. Your loan costs will fill in properly. Your down payment is just 20% of this purchase price. This is the new mortgage balance. Initial repair cost. Did he have to do any repairs on this?
So he didn't. This property was actually an owner-occupied property, and they were moving to Colorado Springs. It was a really nice property. We paid $181 for it. You're going to see what the rent is in just a minute, down to that $1,700 figure. But this one, he was able to literally go in and open it up that weekend and get it rented.
Mm-hmm. Great. So if you have repairs, you can put in here if you need $1,000 for cleaning or, tenant placement, or maybe you need a whole renovation at $25,000. You put that in there, and that's going to factor into your initial investment. But in this scenario, they didn't have any money they had to put in. Interest rate, this was an adjustable rate, so it's very low, 4%, and it was a 30-year term. You can also factor in if you want to pay extra principal, but for right now, we're going to leave that blank. Now, monthly rent. How much was this property rented for, Charles?
It was rented for $1,700.
Okay. And let's just say if we put information here that there was additional information or additional unit for $1,500, it's going to say it's not included because we're not doing a 2-unit property. So it's important that we have our appropriate number of units selected up here, appropriate down payment, and then it'll factor in that rent. Okay. But again, in this case, 20% down, 1-unit property, no rent for the second unit. Total rental income, $1,700. Now, vacancy. Charles, what is vacancy? Can you explain that to us?
Sure. Vacancy is what percentage the property is vacant that you're not getting rent. So in Metro Denver, in this environment, a condo, townhouse like this, a vacancy rate's a little under 2%, 1.5%, 2%, something like that. Long-term vacancy rates have been about 6%. They peaked to 13% back in 2003. So when you get this tool, and by the way, just reach out to us and we send it to you for free. We'd love to have you use it. We'd love to work with you and show you how to use it better. When you get this tool, you're going to actually input what you want to input. I will tell you that my clients tend to input about 5%. Mm-hmm. Sure, they could be super conservative and put 34%, but that's a little crazy. It's not 34%. Or they could be maybe a little bit optimistic and say it's going to be 1% forever, but I don't think that makes sense. I say 5, 6%, something like that. So that's why we have the vacancy factor of 5% right here. In the next thing, you see the annual rent increase. Well, we're not making that up. That's a 45-year average in Metro Denver. Over that period of time, rents have gone up about 4% per year. Now, what have rents done the last few years? Well, they've gone up 10% a year. They're actually up 40% in the last 4 years. But I don't think that's going to last forever. I don't think anybody thinks that's going to last forever. So once again, you take the spreadsheet, you use the spreadsheet for yourself. You want to be really conservative? Maybe you put 1% or 2%. That's fine. You want to say, well, I think it's going to be 8% the next couple of years. This is your data. You use it the way you want to use it. And then finally, for annual appreciation, that is the 45-year average. So once again, prices have been going up 10% a year, year after year for 4 or 5 years. I don't think that will happen forever. I'm going to take a look at the 45-year history, and that's what that is 6%. And I'm going to say, yeah, probably 6% is going to be the long-term average. Maybe it'll go up 9% next year and 7% the following year and go down 2% after that. Who knows? But When I do this for my own properties, and I still buy properties, this is literally what I put in my own version of the spreadsheet. 5% vacancy, 4% annual rent increase, and 6% annual appreciation.
Okay, now let's talk about annual operating expenses. The first thing we're going to have are real estate taxes. All right, every property is going to have taxes, and you can pull this right off the MLS sheet or off the county assessor's website. Property insurance, $500 is probably a little high. I think they would probably want to talk with their insurance agent because this is probably just an HO6 policy. You can probably get these for $200 or $300. Property management. So Charles and I could teach a 2-hour class on why you should or shouldn't have a property manager. Charles, what's your take on it? Should you have a property manager?
So he's kind of joking because I have a portfolio of properties. I manage them myself, and he has properties. He has a property manager, and I would say, and he would say, we're both doing the right thing for ourselves. Yep. In this case, Scott, who was the buyer, manages his own property, so there's no property management. If you're going to have a property manager, put 9 or 10% there.
Yep, absolutely. If you think you're going to have a property manager, it's really easy. You just do equals, and then it's this field here is your total rental income. So equals B33 times shift 8 0.10. That's 10%. And now times 12. There it is. It's annual. $2,040, so it's 10% of your monthly rent times 12 months.
Or can't you just type in 2040 there?
You can.
Okay, so
what if rents go up? If rents increase to $1,800? It'll automatically fill that in.
So this is a good point. So you as the user now understand and have a video on how to do the auto calculation, which is awesome. Or if you're not really wanting to do that, you could just type in the 2040 and change it if you wanted to.
Absolutely. Yes. You don't have to do it that way. You could just do delete and then 2040, and that could go in there just like that. All right. Repairs and maintenance. So we talk about this a lot. In this scenario, $400 is what they're reserving for repairs and maintenance. You know, we debate this a lot in the office. My opinion is you should be reserving 5% of your rental income for repairs and maintenance. In this case, he's got $400. I think the property 85. Was in pretty decent shape.
Yeah,
right?
So this would be $85. I'm doing that in my head. $85 a month, about $1,000 a year. The reason I have $400.
He's only got $400 a year.
He only has $400. That's the point. And the reason he only has $400 is this property was in great shape. He feels very confident that he's not going to spend more. But once again, you decide what's right for you. We throw out something like 5%, which might be, $85. But it's all over the board. If you think it's going to be high, throw in a higher number. Yep. But this is a real client who actually used this used this Excel spreadsheet. He put in 400 because he felt quite confident. He's been a landlord for 12 years, and that's the number he put in.
Okay, great. So over here, you can see standard 10% of gross rents for property management, generally a minimum of 5% for repairs or maintenance. Let's put in a note here. Let's say generally 5%. However, property,
Exactly right.
All right, generally 5%. However, the property is in good shape, reduced to $400 per year. All right, we're just putting that in there as a note because once you begin to acquire properties, you might not remember when you go back and look at this 3 years from now, repairs and maintenance, only $400. Shouldn't it have been more? Put a note in here for yourself. Now, utilities, if paid by the owner, things you might have to think about, water and sewer, trash, electric. This generally doesn't apply for single units, but if I have a multi-unit, maybe there's not a split water bill, and so water is included in the tenant's rent, but I need to factor it in to my operating expenses. Do I have to pay for trash? Do I have split electrical utilities? Most of the time you will, and the tenant will pay for that, but if not, factor that in. Landscaping. All right. Do we have to? This is a condo, so it's got an HOA. They pay the landscaping, but maybe I want to put in here snow removal. Again, I understand this one is an HOA, but maybe if I am buying a duplex, I need to factor in $500 a year for snow removal. All right. That's what these other fields are for down here at the bottom. And then our biggest expense, HOA dues. All right, this is the monthly HOA dues times 12 months, $3,192, and you can also get that off of the MLS tab. And then if you come down, you have what-if scenarios. This is where you can play with, what if I were to make some changes? What if I got a discount on the purchase price? What if I lowered expenses? What if I increased rents? All right. And this is just kind of global, that you can say, hey, I'm a great negotiator. I'm going to get a 10% discount on price. And then we'll show you what that's going to do for you. But we'll come back and look at that in a few minutes.